Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to hide in plain sight. And today we're diving into John Wiley and Sons' latest quarterly report, a document that is packed with more numbers than a tax accountant's holiday wish list. And we'll see if this academic publisher is hitting the books or failing the test. Stick around because we're about to decode what is really going on. And hey, if you love getting the inside scoop on corporate filings without all the jargon, make sure you are subscribed and hop into our Discord community link below for even more insider chat. This filing is all about what happened for the last 3 months of October of 2025 and how that compares to the year before. It gives us a snapshot of how well the company is doing right now. John Wiley and Sons, or Wiley as they're commonly known, is a pretty big name in academic publishing and research. They deal with journals, books, and online learning tools for universities and professionals. Think of them as the folks who help researchers share their findings and students learn new things. Looking at their assets, which is basically everything the company owns, it stands at a massive $2.46 billion as of October 2025. That is down a bit from April, but it is still a huge amount of stuff. This includes cash, money owed to them, technology, and even goodwill, which is kind of like the brand's reputation. Now, liabilities are what the company owes to others like debts and bills. Wiley owes about $1.72 billion, so they own a lot, but they also owe quite a bit. It's important to see how these two numbers balance out. Let's peek at a key financial table, the Statement of Financial Position. As of October 31st, 2025, cash and cash equivalents were around $67 million. That sounds like a lot, but compared to their total assets, it is a relatively small portion. Also, their accounts receivable, which is the money customers owe them, was over $200 million. This is pretty standard for a business of this size. On the flip side, their accounts payable, what they owe suppliers, was about $47 million. They also have significant accrued royalties, over $126 million. This simply means they owe money to authors and creators for their work. Now, let's touch on a quirky part of their balance sheet. They have an accumulated other comprehensive loss, and it is a pretty big one, over $481 million as of October 2025. This is a collection of unrealized gains and losses that haven't been fully realized and don't directly go through the profit and loss statement. Think of it like value fluctuations in things like foreign currency translations or interest rate swaps that haven't hit their bottom line yet. It is a bit of an accounting nuance, but a large enough number to keep an eye on. Moving on to the income statement, this tells us about their performance over a period. For the 3 months ending October 31st, 2025, their revenue was a little over $421 million. This is actually a slight decrease, about 1% from the same time last year. Not ideal, but not a disaster either. Their operating income, which is profit from their core business operations before interest and taxes, saw a nice jump. It was about $73 million, a 14% increase compared to the previous year. That is good news, showing they're managing their expenses well, even with slightly lower sales. Finally, their net income, the bottom line, was almost $45 million. This is up 14% from the previous year, which is definitely a positive sign. Even with slightly less money coming in through sales, they managed to keep more of it as profit. This suggests they're getting better at cutting costs. And for the common shareholders, their diluted earnings per S-share, a key measure of profitability for each share of stock, was 84 cents. That is up 14% from last year. So even though sales were a bit down, the earnings per S-share grew nicely. This is often a sign of good cost management in action. Now, a company like Wiley with a massive global operation often goes through restructuring. They spent about $6 million on restructuring and related charges in this 3-month period. This usually means they're reorganizing, cutting staff, or closing down less profitable parts of the business, which can be painful but is sometimes necessary for long-term health. They also recorded a net loss of over $2 million related to selling off some of their businesses or assets. This is part of their ongoing strategy to focus on their core strengths. It shows they are actively managing their portfolio, shedding what doesn't fit anymore. Let's look at cash flow for the 6 months ending October 31st, 2025. They used $76 million in cash for their operations. That might sound bad, but sometimes companies use cash to invest for future growth, like developing new products or making acquisitions. In fact, their investing activities actually provided $72 million of cash. This positive number is largely due to selling off some businesses, as we mentioned. So while operations might use cash, they got a good chunk of money back from divestitures. And for financing activities, they used almost $13 million. This typically includes things like paying back loans, buying back their own stock, and paying dividends to shareholders. It seems they paid back more debt than they took on, which is generally a good sign of financial health. This metric, free cash flow less product development spending, is a way to look at how much cash is truly free after investing in the future. For For the 6 months ending October 31st, 2025, they were still in a negative position here, using over $107 million. This indicates they are heavily investing in developing new products and services, which for a digital content company is crucial. Now, let's break down how the different parts of Wiley are doing. Their research segment, which includes publishing and research solutions, showed some really solid growth. Revenue here was up 6%, driven by their publishing arm. They're seeing more author-funded open access articles, which means more researchers are paying to publish their work. And they're also expanding their AI licensing revenue. That growth is a huge positive. The learning segment, which covers academic and professional education materials, saw a significant drop. Revenue was down 11%. They're facing market softness with lower print sales and consumer spending issues. Even their AI revenue in this segment is down compared to last year. This is a segment that is clearly facing headwinds. And finally, their held for sale or sold segment, which includes businesses they've divested, is pretty much gone now with zero revenue in the latest quarter. This is a clear sign they are slimming down and focusing on their core successful areas. In research, the adjusted EBITDA margin improved to 33.5%, showing they're becoming more profitable in this key area. However, in learning, the margin decreased slightly to 40.1%. While still healthy, it is not as strong as it was. Let's talk about earnings per S-hair. When you strip out all the one-off costs and gains, their adjusted earnings per S-hair or E-piece was $1.10 for the quarter. This is up from 97 cents last year, a solid 12% increase. This shows that even with some ups and downs in their businesses, they're managing to improve profitability on a per-share basis. More importantly, for the 6-month period, adjusted EPS grew 9%, showing consistent improvement. Another interesting number is amortization of intangible assets. For the 6-month ending October 31st, 2025, it was over $26 million. This represents the gradual expensing of things like acquired content rights and customer relationships. It's a significant cost, showing the value they place on intellectual property. Wiley's overall strategy seems to be about focusing on their core strengths in research and learning while divesting non-core assets. They are heavily investing in digital products and services, with over 83% of their revenue coming from digital sources. They're also committed to growing through acquisitions and strategic investments, which is a classic way for established companies to maintain growth. Looking at the financials overall, Wiley seems to be navigating a challenging market pretty well. Revenue is slightly down, but their operating income and net income are up, driven by cost savings and strong performance in their research segment. The learning segment is a concern, but the growth in research and their strategic portfolio management are promising. A significant risk they're facing relates to artificial intelligence. There is a class action lawsuit against Anthropic, a major AI company, for using copyrighted content to train its models, and Wiley is aware that their content is involved. While the settlement amount and their portion are not yet determined, this highlights the evolving legal landscape around AI and content ownership, a major risk for any content-based company. This is definitely something to watch closely. It is also worth noting their print book sales return reserve. It is holding steady at about $9 million. This is a standard accounting practice for book publishers, acknowledging that some books are returned by retailers. It shows they are managing their inventory and sales expectations prudently. Their effective tax rate is interesting. The US GAAP tax rate was about 25% for the 6-month period, but their adjusted rate, which strips out certain items, was similar. This suggests they are paying a relatively consistent tax rate, which is important for predictable financial planning. Some tax reform changes in Germany are also impacting their deferred tax balance this year. So what is the verdict on Wiley's latest report? They're showing resilience. Their core research business is growing and becoming more profitable, and they are actively managing their portfolio by selling off underperforming assets. The learning segment is struggling, which is a drag, and the AI litigation risk is a significant cloud on the horizon. However, the company's commitment to digital, its focus on cost savings, and its strategic investments paint a picture of a company adapting to a changing landscape. It looks like they are weathering the storm, but they need to keep a close eye on the legal challenges and the performance of their learning division. Alright, that is our deep dive into John Wiley & Sons' latest quarterly report. What do you think about their strategy and their financial health? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up, subscribe for more corporate insights, and join the conversation on our Discord linked in the description. Thanks for watching, and we'll see you next time.